Cognizant. You've definitely heard the name. For a long time, it's been one of those steady, reliable players in the IT services world. But things are changing, and fast. The company is at a really critical turning point, and it's betting its entire future on a massive turnaround. So let's break down what's really going on.
From an investor's point of view, it really all boils down to one thing. Is this sleeping giant finally waking up? And maybe more importantly, is this a chance to get in before everyone else catches on?
The core idea here, the whole investment thesis, is actually pretty simple. You've got new leadership with CEO Ravi Kumar at the helm, and he has a crystal clear plan. He's going to restructure the old business to free up cash and then pour that cash into the single biggest opportunity in tech today. Yep, you guessed it, artificial intelligence. But before we get all excited about the future, we have to understand the past. Why was such a drastic change even necessary? To see that, we've got to look at the numbers. Okay, just focus your eyes on that top line, total revenue. See that period from 2022 to 2024. The numbers are almost completely flat. We're talking a tiny crawl from $19.4 billion to $19.7 billion. In the tech world, if you're not growing, you are absolutely falling behind. This stagnation right here is the core problem the new CEO walked in to solve. So the big question is, how do you restart a stalled multi-billion-dollar engine? Well, the new leadership came in with a really powerful two-part playbook. And the strategy is incredibly direct. Pillar 1, they're calling it the NextGen Program. This is all about cutting costs, making the company leaner, and just simplifying how everything operates. Pillar 2, well, that's where the magic is supposed to happen. They take all those savings and plow them right back into the future, with a huge focus on AI. It's simple. One part funds the other. So what exactly is this NextGen Program? Honestly, think of it as a massive corporate spring cleaning. They're streamlining everything and even shrinking their office space to fit this new hybrid work world. But the crucial point is, this isn't just about saving a few bucks. It's about generating the fuel for their brand new growth engine. And this is what that fuel is paying for. A $1 billion bet on artificial intelligence. This isn't some side project or a little experiment. No. This is the new centerpiece of their entire strategy. Okay, that all sounds great in a PowerPoint deck, right? But is any of it actually working? Let's switch over to the evidence and see if we can find any green shoots, any early signs that this huge bet is starting to pay off. And here is our first big piece of hard evidence. Financial services is a massive part of Cognizant's business. In fiscal year 2024, it was actually shrinking, down 1%. Now, fast forward to the second quarter of 2025, and just look at that reversal. It's now growing at almost 7%. That is not a small recovery. That is a dramatic U-turn in a key part of the company. And this momentum seems to be company-wide. The total value of new contracts they've signed over the last year, it just hit a record, $27.8 billion. This is a super clear signal that clients are buying into the new strategy, and that demand is really picking up. Now, that record bookings number gives us a really important metric for investors, a book-to-bill ratio of 1.4. So what does that actually mean? It's a powerful clue about what's coming next. It means for every single dollar of revenue they're making right now, they're signing $1.40 in new deals. In other words, future growth is already being locked in. Okay, so we're seeing the operations improve, and the momentum is building. And this brings us right to the heart of the investment case. How is the stock market actually valuing this turnaround? Is there an opportunity here? So, how does Cognizant stack up against the competition? Here, we've got them side by side with the other giants in this space: Accenture, Infosys, TCS. They're all huge, successful companies. But when you look at how the market values them, one number just jumps off the page. And here it is. This is the whole ballgame. Cognizant is trading at a PE ratio of around 13.6, while one of its main rivals, Accenture, is over 20. That is a huge discount. The bet is pretty simple. If this turnaround keeps working, that valuation gap should start to close, and that could mean significant upside for the stock price. But of course, no investment is a sure thing. A good analysis has to look at what could go wrong, what could derail this whole turnaround story. There are really three main risks to keep on your radar. First, if the economy goes south, clients could pull back on spending. Second, the competition here is absolutely fierce, and there's always the risk they just can't execute the plan. But that third one is critical.
the war for AI talent. The big danger is something called a margin squeeze, where all the money they save from restructuring just gets eaten up by the insane salaries needed to hire top AI experts.
But management is definitely not blind to this. As the CFO, Jatin Dalal, says right here, the whole strategy depends on this link. The cost savings from the NextGen program is precisely what allows them to invest in growth. One literally cannot succeed without the other.
So here's the bottom line. You have a new strategy that seems to be working. You have clear evidence of improving momentum, and you have a stock price that looks cheap compared to its peers. So it all comes down to this one final question. Will this billion-dollar bet on AI be the thing that finally closes that valuation gap and completes Cognizant's comeback story?